Hello, in this video we'll talk about involuntary conversions and how there are special non-recognition rules that apply to certain involuntary conversions where potential gain can happen. So what exactly do we mean by involuntary conversions? You hear that? Sounds like a storm is in the air. What happens if your business building is destroyed in a tornado or a hurricane? Well, potentially, if your building is destroyed, whether it's business, investment, or personal, and let's say it's fully destroyed, it's leveled to the ground, and you get insurance proceeds from that destruction. Well, this provision in dealing with involuntary conversions provides a special non-recognition rule if you potentially would have had to recognize gain, the amount realized being the cash you would receive from the insurance company, minus the adjusted basis of the property. If there's a gain there, you potentially may not have to recognize that gain. If you do certain things with the money, you reinvest it in a similar type of property. The idea being that if you go back to our non-recognition, our general discussion, there's two major components to all non-recognition rules. First is liquidity. You don't have the cash to pay the specific tax. So that affects the efficiency, the economics, and we don't want to de-incentivize certain transactions. The second component is that there's an economic component where you're in the same position before or after. Now, the involuntary conversion rule actually has a twist in it. It's more of it also has some elements of social policy. Why should we tax you? Because of some event that's outside your hands. That's what the involuntary nature means. It's not a voluntary event, it's involuntary. So let's go ahead and talk about these specific items. So the first thing that you have to have here is you have to have an involuntary conversion. So you must have an involuntary conversion. Involuntary conversion. And the tax code really focuses on 4 different ways that you can have involuntary conversion. The first is what we normally think of through destruction of your property in whole or part. In whole or part. So the storm example, right, a hurricane or a tornado, that storm destroying your property in whole or in part, that's considered involuntary conversion. Involuntary. Is the storm a voluntary act on your behalf? No, it's not. Other examples include fire, right? That kind of stuff. Storms, fire, whatnot. Another type of involuntary conversion is theft. Again, it's not something that you can control. It's involuntary. You don't actually want to steal your own property, right? It's theft. Another event is seizure. So, eminent domain. Say a government takes your property and gives you the fair market value of the property, and they're going to build a highway. They're going to bulldoze, they're going to level down your building, and they're going to build a highway on that land. And they have every right to do so because if they meet certain criteria. Okay? If they meet certain criteria, they can do so. They're eminent domain power. So that's a seizure. Any gain on that, you're not going to have to recognize. All right? And then finally, condemnation. Say you have property that's been condemned because it's just not habitable or some other reason, condemnation. If it's condemned by city, state, whatnot, locality, then that's considered involuntary conversion. Now, one thing I want to note about, most non-recognition rules are mandatory, meaning that if you have the criteria, you must apply it. This special rule for involuntary conversions is an election, meaning if you meet the criteria, you can elect. You don't have to do it. So this is very, very, very good for the taxpayer. This is taxpayer friendly. It's for the taxpayer. Whenever you have an election provision like this, it's all about the taxpayer. And again, that goes to the social policy. So that's why involuntary conversion has a little twist with this election. Usually it's mandatory. The like-kind exchange rule that we learned, remember that's mandatory. It shall be binding if you meet the criteria. No gain or loss shall be recognized. This one is election. If you meet the criteria we're going to talk about, you can elect out of it. you have to elect in. The default rule is you're not going to be able to not recognize. So you have to elect if you want this treatment. You have to elect in. Okay, so we have involuntary conversion, let's say. Let's say that A, right? A's house is destroyed in a hurricane completely. And again, when it comes to this provision, involuntary conversion, this applies to business, investment, or personal. Business, investment, or personal. Personal use. All three of the big three. It applies to all of them. There's no difference. Okay? So whether it's a personal home, an investment home, or a business home, A's property has been destroyed. A gets money from the insurance company for the fair market value. Let's stop there at that point, okay? So we have involuntary conversion because a hurricane came and completely destroyed A's property. We'll call that property number 1. Property 1 is destroyed. See that? Property 1 is destroyed. The next thing is that the realized gain must be, there must be a realized gain. You cannot have a loss. If you have a loss, this provision doesn't apply and you're going to recognize the loss, which is good for the taxpayer. That's a good thing. Remember that realized gain from our previous videos is the amount realized minus the adjusted basis of the property. So you have to have a realized gain here. If it's a loss, then this rule is not going to apply, right? It's not going to apply. It only applies to gains, okay? So here, the proceeds, let's assume this property doesn't have any liabilities on it. So the proceeds are the amount realized. The proceeds received minus the adjusted basis of the property to A, and let's say that A has a gain here. Okay, so now once we have a gain, we have two different possibilities. We can convert the property directly into another property. So let's say that your property is destroyed, and by being destroyed, you get another property that is considered similar in use. Conversion into similar use property. Similar use property. So first I want to talk about what is similar use property. Similar use property, under a revenue ruling that's been around for a while, focuses on a subjective notion. There's different tests out there, but it focuses on whether properties are similar with respect to service for the taxpayer, nature of business, any risks involved, or management. So there's different factors that we look at, or management factors. So these are all factors. Depending on what type of activity is, obviously some are going to be more important than others to look at, but that's what we look at. So just think of similar use property very, very much the same. So if A was renting out a house and later on is going to use the money to buy another house that's very similar, same square footage, gets the same amount of money, that's likely to be similar use. And because of the nature of the business, A is still renting out, same amount, same square footage. Maybe it's in the same neighborhood or whatnot. But that's going to be similar use property. All right, similar use. But the point here is that you can't have a personal house and then get money and then buy an investment. That's not going to work. Usually when you go to different activities, this is not considered similar use. So if you go from business to investment, or investment to business, or business to personal, or personal to business, or any of these, that usually doesn't work. But so usually you have to be in the same category, and even that's not enough. Now this is very broad though, I will say. Similar use property is very broad. Again, this is good for the taxpayer. So conversion into similar use property, that's the important language. Conversion is similar use property. That's important. That's if, let's say that A's house was destroyed in a fire, and somebody set fire to that. And in order for A to get restitution, get damages or an award to be made whole, let's say A is directly awarded a house maybe across the street by that property. I'm sorry, by the party that damaged A. By setting fire to A. So A actually gets property. Does that happen that often though? No. It used to, maybe, quite a long time ago, but not really the case anymore. Now what happens is insurance, or just through the court systems, the parties property will be destroyed, and then guess what? You get cash money, a check for the amount, the value of the property. See that? Very important. So that's what the second part is. The second part is when you get cash or property that's not considered similar in use. Property that's not similar. So if you have a direct conversion into similar use property, which again I said is very rare, you don't usually see that. That's simply just going to be no gain recognized. And I'll show you the basis rule, the corresponding basis rule, which applies here as well. I'll show you how to calculate that. So no gain is recognized. That one's simple. But what happens if you have cash or property that's not similar? Well, the next question becomes, what do you do with that cash or property that's not similar? If you use the cash or property that's not similar to acquire property that is similar in use property, right? Same definition. To acquire similar use property, then you might still be able to get non-recognition of a gain. The question becomes timing. When do you actually take that cash or property that's not similar and you acquire the property that is similar? So the general rule is 2 years, but there's some special provisions that allow 3 or more years, meaning you have up to 2 years to use that cash or property not similar to acquire. 2 years or special cases, we'll just say. But the general rule is 2 years. 2 years. So what am I saying? So again, let's say that in year one, A's house is destroyed by a hurricane and it's insured, fully insured. A gets money on it. A uses that money and takes that cash. A takes that cash and uses it, all the cash, and buys property 2, which is a very similar house. Let's say A owned a house, personal house, got the cash, and now buys a new house. But A did that 1 year later. Why do we have this time constraint? Well, think about it. When you get your money, are you instantly going to be able to go out and buy that house? No, you have to find a suitable house to live in that you want, right? You can't let this storm, this event, go out and I'm going to have to buy a house within a month. You have to have some reasonable time, right? To go out, okay, I need to look at houses. And you're dealing with all these events, right? Your destruction of your house, probably your personal, your treasures, your items like your pictures and stuff that can't be replaced. So you're probably distraught after the storm. And guess what? Now you got to go out and look for a house. So that's why Congress gives this 2 year time period, even more in special cases for certain disaster times that occur. So let's say that A goes out in 1 year and buys a new house that is similar use property. It's very similar. Again, A is going to use it for personal purposes, going to live in it. Very similar size, type of house, and whatnot. 1 year later, well, because it's within the time limit, guess what? Gain on that is not going to be recognized. If there is gain. If there's loss, obviously this doesn't apply. So if we have that time period, that 2 year time period, the next question becomes, did we use all the proceeds? So I'll do a simple example in a moment. If we don't use all the proceeds, so I'll just say this one's called proceeds. So again, A's house is destroyed in the hurricane, A gets money. So that money is proceeds. Did we use all the proceeds? If we use all the proceeds, it's going to be non-recognition. Okay? If use all proceeds, let me put a little line here. If use all proceeds equals no gain. But if we don't use all proceeds, we recognize the gain for the lesser of, and this is going to look very familiar. It's going to look very similar to our lesser of rule for like-kind exchanges. We recognize the gain to the lesser of the realized gain or the amount of proceeds received, so we'll just say amount received, minus the actual proceeds used on the similar property. On the similar property. Okay? On the similar property. So I want to do a few little quick examples. So let's say that A's property is worth $500,000. It's destroyed. It's insured for that amount. So let's just say that A gets, I don't know, $450,000. So let's say it's a $50,000 deductible. So A gets $450,000. A turns around and buys a house number 2. This was house 1, fully destroyed, for $450,000. And A does it within a year. And let's say there was a $100,000 gain on that transaction, on that event. Okay? Let's say that the adjusted basis on the house was $400,000, right? So, I'm sorry. Let's say that A's basis is $350,000. So A receives $450,000 cash, right? Because you just take away the deductible, $50,000. So amount realized $450, adjusted basis $350. So it's a $100,000 realized gain, and then A is going to use all $450 of the cash received, the proceeds received, to buy house 2 within a year. So we go down our analysis. We have involuntary conversion. We have a realized gain. Is it conversion into similar use property? No, because it has to be a direct conversion. You can't have cash or non-similar property involved at all. If you do have cash or non-similar property, then you go over here. Do we have that? Yes. We have cash. Do we use the cash to acquire similar use property? Yes. Assume that the property is similar in use. Personal house for personal house, very similar size and whatnot, so it's going to look like it. Do we do it within 2 years? Yeah, if you do it within 2 years, you're good. If you don't do it within 2 years, you got to look at the special cases. So that could be an issue to look at. So the proceeds. Do we use all proceeds? Yes. We used all proceeds, so there's no gain recognized. But let's say that A pockets $50,000 of the proceeds and buys a house for $400,000. Okay. So the realized gain is the lesser of the $100,000 recognized gain is the lesser of the realized gain, which again was $100,000, right? The proceeds were $450, the adjusted basis was $350. So the realized gain is $100. Or the amount received, which was $450, minus the amount used on the similar property, $400,000. So that equals $50,000. Then it's the amount that you don't use on similar property. So that means that the recognized gain is going to be $50,000. $50,000. You see that? Very important to understand that. Let me do another example. So example 1, A used all the proceeds, right? So there was no gain. Example 2, we had a $50,000 gain, right? Because $50,000 was the amount received, $450 minus the amount used on similar property, $400, gave us $50,000. Because the $50,000 was the $400,000 amount received minus the $400 on house 2, the similar property. So that gives you $50,000. So the next example, what if A gets the same amounts, gets $450,000 cash, there's a realized gain of $100,000, A buys a house, let's say for $350,000, and then acquires another house that's not similar in use. Let's go through the analysis. So we go through all this. We're down here again. The proceeds. If we use all the proceeds on the similar property, no gain. Well, we didn't do that. So the recognized gain is the lesser of the realized gain, which is $100, or the amount received, which is the $450, minus the amount used on similar property, which is the $350. The other $100,000 was used on non-similar property, so therefore we use that amount. So we use the lesser of $100,000 realized gain or $100,000, so it's both of them are $100,000, so we use $100,000 recognized gain. See how that works? So that's very important to understand. So the last thing I want to talk about is, as you remember, in all non-recognition rules, there's always a corresponding adjusted basis rule. We always start with the taxpayer's old adjusted basis. So the taxpayer's adjusted basis in the old property. The property that was destroyed, converted, whatnot, right? So that is carryover. Remember we talked about carryover principle. We carry that over. Plus any gain recognized on the transaction minus any loss recognized. And just like I've mentioned on other non-recognition rules, loss recognition, when you have these kind of rules, is very rare. Usually you have to have some type of bifurcated transaction, which is broken into different parts. And finally, less or minus any money that was received but not used for similar property. But not used for similar property. So this formula makes a lot more sense. Well, the other one makes sense for like kind exchanges, but this one is a lot easier to grasp. It's a lot easier to grasp. So let's take our example, right? The adjusted basis was $350. The amount of the proceeds received were $450. So that was a $100,000 realized gain. The building or house that was similar use property was purchased for $400. So $50,000 was used. So that means if we go down our analysis, we go all the way down here, we recognize the lesser of the realized gain, which is $100, or the amount received, which was $450, minus the amount used on similar property, which is $400. So $50,000 is recognized. When we apply our adjusted basis, we first carry over the basis of property number 1. A's old property. That's carryover basis. So that's $350,000 plus any gain recognized. So plus the $50,000 gain recognized. That came from the amount received minus the amount used on similar property. Minus any loss recognized. We don't have that, and it's going to be very rare for you to have that here. Minus the money received but not used for similar property. We got $450,000 in proceeds, but we only used $400,000. So that's $50,000 we subtract out. So $350,000 plus $50,000 gain recognized minus $50,000 money received but not used gives us the basis in a new replacement property of $350,000. How can you check that? If we sold that property the next day, or the same day, which has a fair market value of $400,000, the adjusted basis is $350,000, we'd have a $50,000 gain. Think back to our previous property. We received $450,000 in proceeds. So our amount realized was $450,000. Our adjusted basis was $350,000. So that was $100,000 realized gain. We only recognized $50,000, so the other $50,000 is considered lurking. So guess what? That lurking gain is still in that other property. And this is the shortcut method that you can use for the Section 1031 like-kind exchange. It doesn't work all the time, but here it does. This is the shortcut method. So you can always check your work, and that's very important to do. Now, I want to mention again that this is an election provision. If you meet all these criteria, you can elect to not recognize the gain. It gets deferred by getting put in here, and you have to meet these criteria. If you have a loss, though, remember that this provision doesn't apply. And if you do have a gain and you do want to recognize it for some reason, you're welcome to do so. You have to elect if you do want to not recognize the gain. If you don't want to recognize it, you have to elect. If you don't elect, you will recognize it. That will be the transaction. All right. Another thing I want to mention is that when you look at the characterization videos later on, which will be a later topic, the holding period does tack. So the period of time that A held property 1 tacks on to property 2, which is interesting because it has the 1-year period, but because we use the carryover basis, a portion of the basis uses the previous property, we also get to tack on the amount of years that A held property 1. So if A held property 1 for 10 years, and then A acquires property 2 and sells it 2 months after acquired, it was actually held for 10 years and 2 months, not just 2 months. See how that works? So I hope you enjoyed this video, and stay tuned for more property transactions videos.